Hello and welcome to today's Premium Account Market Update for July 2016. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presented today, myself, Leon Hine, Managing Director of Investor Signals. I have 18 years of experience in the financial services industry as a licensed securities and derivatives advisor. The topics for today's presentation, we look at the macro update driving equities. We roll through the ASX top 50 with a focus on the FY 16 earnings, the technical trends, portfolio allocations, and conclude with the short-term market outlook. The Investor Signals Premium Account Service is a model portfolio of ASX top 50 stocks. We utilise call options to enhance portfolio returns. We're focused around effective ownership on ex-dividend periods, generating above average cash flow from a combination of the dividends and the call options while still seeking capital growth. It's all done in a strict investment mandate, therefore suitable for self-managed super funds, and importantly the assets remain in your name. If you'd like to know more about the Investor Signal service, please contact me using the details on screen. Moving straight into a graph of the Dow Jones being the top 30 companies in the US. As a general benchmark, US S&P 500 valuations trading about 17 times forward earnings. We're probably expecting something in the order of, I think, close to sort of 6% earnings per share growth in the S&P 500. Now, we get the first test of earnings coming through this week in the US with Alcoa, I should say, reporting their earnings result. We've also started to see the early stages of the US financial companies with BlackRock, Citigroup and Wells Fargo reporting towards the end of the week. I get the sense at the moment that there's a little bit of a relief rally taking place in global equities, and we can see there on screen that the Dow's actually for the first time created what looks to be the early stages of a higher high and higher low. It's worth considering that the US indices really haven't gone anywhere for the last 18 months. We're sitting pretty much back at sort of the prior peak of around 18,000 points in the Dow. If we have a look at sort of how that compares to the NASDAQ, say since July last year, we're still sitting below those highs. What worries me a little bit here with the NASDAQ is we've still got this lower low and lower high pattern in the NASDAQ, and what I'd like to see happen over the coming weeks is it break higher, and that's obviously only going to come through as a result of better earnings results out of the big US tech names. So when we look at the earnings report last quarter in the US, we actually started to see some deterioration in the big tech names, and that really weighed on the market. So it'll be interesting throughout the month of July, and it's more sort of towards the middle to back half of July that we start to see the big tech names report. But they'll be interesting to keep an eye on sort of those underlying earnings growth there, and that'll sort of feed through to what the picture looks like in the NASDAQ. Given that the S&P 500 looks to be putting in a higher high and a higher low and trending in a bullish pattern, I'd probably expect that the NASDAQ actually breaks out of this short-term sort of downward resistance here, and we actually begin to see sort of a more positive picture there evolve in the NASDAQ. Just to conclude the macro picture, just to have a look at a couple of relevant benchmarks here. The Aussie dollar, we're starting to see it break higher and potentially create a higher low there. So that's encouraging us, and I think that's probably more being fed by a more optimistic outlook towards commodity prices and countries that are heavily exposed to commodities. The Nikkei, so we're seeing this sort of put in a fairly weak technical structure, and that's reflected there with the ongoing lack of earnings per share growth that we're seeing in the Nikkei 225 companies. But we continue to sort of keep an eye on probably the two trouble spots in the market being Japan and potentially Shanghai Composite or the Chinese market. I'm probably less worried about the Chinese market. I'm thinking that we probably slowly start to see this push higher and actually maybe break through that 3,000 level and begin the early stages of that higher high, higher low. Now, this is an area that's obviously driven a lot of volatility over the last 4 weeks, being the UK market and the surprise vote for Britain to leave the EU. Interesting, the FTSE 100 rebound very strongly. So when you look at this sort of spike lower here, was really the day following the vote to leave. And we've seen the market rally back and create effectively a higher high structure, which will soon sort of evolve into a more bullish pattern of sort of a higher high end, the higher low pattern. So it's just interesting to point that out for all the negativity in the media, the way that the actual price behavior is. And then finally, just to touch on the XJO before I move into the top 50 companies. So in line with sort of what we're starting to see in the US market, I think we're probably in the early stages of where buying interest or a rotation starts to occur, where capital comes out of some of the more slightly expensive defensive yield names and maybe starts to gravitate back towards the resources and potentially the banking sector. I think we're at the very early stages of that happening, and I don't think there's enough evidence to say that becomes the new overweight play in portfolios, but it's certainly worth keeping an eye on and trying to at least have some short-term positioning around the technical bounce in those banks and resources that I'm anticipating. I think what we could start to see off the back of this first higher high and higher low, and again, it's important to recognise we haven't seen this technical pattern in over a year, so it's been about 18 months that the market's been in sort of a sell-off. Within that, there's obviously been sectors that have been doing well, and we've been predominantly exposed to those, but what we're seeing here on an index level is the beginning of a more bullish structure occur. And for that to play out, then obviously it needs the banks and the resources to start to contribute. Okay, on that note, let's move into the top 50 companies. Up on screen is AGL. This has been one of our preferred defensive names. And at this level, the stock should deliver somewhere around 6 to 8% earnings growth, trades on a 3.5% dividend yield. Analysts had pretty bullish forecasts on AGL. I think over the next 12 months, we'll probably see some of those forecasts ratchet back a little, and I think AGL's pretty full value where it is, and it really trades sideways. So it's a suitable stock to own, sell tight covered calls, and a combination of the dividend and the call option drive sort of 10% cash flow out of it. Amcor, as I spoke about in last month's recording, we've seen the company downgrade earnings by the tune of around 300 to 400 million, a combination of FX exposure and restructuring costs with their manufacturing plants. At this level, taking into account the earnings downgrade, I have Amcor trading about 3.7% dividend yield. I think we can forget any earnings growth into 2017, and I think the stock largely trades sideways around this $15 to $16 level with a little bit of bullishness in the market. I think it can trade back up to 16. It's probably not supported by underlying earnings growth short term at that level. I think it runs into resistance. So again, it's a good name to own, but want to be selling covered calls to complement the return there. AMP remains under pressure, certainly on the radar given sort of the prospect of a more bullish turnaround in equities in general, but still cognizant of the lower low, lower high pattern there. Likewise in ANZ, and I'll just sort of broad brush all the banks where I think there's an increasing probability that we're looking at the early stages of a bounce in the banks and resources. So we keep an eye on that, but we run fairly tight stop losses to the extent that we're sort of really sort of scaling into that trade. APA Group, we continue to like this. I think this provides a defensive allocation of portfolios on a 4.5% dividend yield. ASX, this is one that we've liked, trading at about just over a 4% yield, 5% underlying earnings growth. I think it's getting expensive now at these levels, though. Certainly would be keen to be a buyer of ASX on any major pullback over the next 6 months. Horizon, I think this looks expensive, and I think at 100%, with no revenue growth, 100% payout ratio on the dividend, there's not much margin for error here with AZJ. We'll be watching this upcoming earnings result closely there. BHP, in line with my comments on the broader index and the banks, I think we could be looking at the early stages of a bounce in these names. Brambles, I think I like this name. It's worth adding into portfolios on roughly about a 2.8% dividend yield. I think the company delivers about 6 to 8% earnings growth. Again, it's expensive, so owning it, selling the covered calls is essential. CBA, in line with the broad brush comments there, I think we're looking at the early stages of a bounce in the banking sector. Coca-Cola, we saw this, a lot of analysts upgraded their outlook on Coca-Cola, and it was really driven by about 3 to 5% underlying earnings growth and the relative value to the rest of the market. So Coca-Cola was trading on around about a 5.5% yield. We've seen that compress down a little to roughly around 5.2%. Fair value for the stock's around 875. I don't know that the company's going to significantly surprise on the upside with the upcoming earnings result. So again, we've been fairly aggressive selling the $9 to $9.50 covered calls over it and driving up to 10% cash flow from the dividend and the call option. Computershare, we've seen this stock sort of trend lower off the back of 18 months of sort of earnings misses, and we'll watch the upcoming earnings result with interest. I think sort of the pressure's still to the downside, but I think the price more than the share price currently more than allows for sort of any ongoing deterioration in the earnings picture. So I think in the context of Computershare, I think it may be that the earnings results probably not as bad as the market fears. CSL, we continue to like this name. I think growing earnings at around about 12%. The stock trades on just under a 2% dividend yield. So again, if we're owning this, we're selling the covered calls. We own it at lower levels, and we sold the $110 calls into December, which we received about $4 in premium for that. So we're looking for an effective exit price there around $114 in CSL. Caltex, I think this one needs to go onto the radar. I think with the pullback here at around $31, $32, I think Caltex provides a good buying opportunity, just under a 4% dividend yield, and they should grow earnings around that sort of 8% over the next 12 months. The property sector is starting to look expensive, and to put this in context, Goodman Group's trading about 18 times earnings now. The yield's compressed down to less than 3.5% yield. So at some point, you'd have to start to say that these property trusts consolidate and move sideways. GPT again up at around 18.5 times earnings, just over a 4% dividend yield. It looks expensive. It has been our preferred property play. We own it at much lower levels, and we've made regular returns out of the stock through this uptrend, and to the extent that we own it at the moment, again, we're getting aggressive and selling the covered calls to complement the dividend there. IAG, I think this is worth just keeping on your watch list on this pullback. I think it's an environment where insurance stocks struggle to really grow earnings, and I think IAG at 14, 15 times earnings on about a 6.5% dividend yield, it's really more a story of can the upcoming earnings result sort of appease the market and we get some sort of slight re-rating in IAG because of the attractive dividend yield that it offers. But I think the range is somewhere between sort of $5.25 and $6. I don't see it doing too much outside of that. James Hardie, we're still keeping exposure here. I think this name gives us exposure to sort of one of the fastest growing areas of the US economy, which continues to be their housing market and construction. So whilst the stock trades on a fairly high PE and less than a 3% dividend yield, owning it, selling covered calls, I think captures a blend of income from the call option and the dividend, as well as allowing some capital gain into sort of that October-November period. So we continue to like James Hardie. Lendlease, really just being patient here. We'll have to wait and see what the upcoming earnings result looks like in Lendlease. If they can deliver 8 to 10% earnings growth, it'll surprise the market to the upside. The market's baked in a fairly negative scenario here with problems around settlement of units in Sydney and Melbourne, and in general, I think sort of short selling in Lendlease as a way of capturing sort of exposure to a potentially overvalued Australian housing market has weighed on the stock. We could see a bit of a short squeeze if the earnings result comes in a little bit better than expected. So we'll watch that one with interest. Medibank Private, I think back here at around $2.90, it's a reasonable buying opportunity. I've got the stock trading about 20 times earnings on a 3.6% dividend yield. Uh, I think with some of the issues that the company's facing at the moment, I think it's more of a consolidation play. Don't see it trading too much higher, so it really is a combination of the dividend and the call option. I think downside risks are pretty limited. Macquarie Bank, so in line with the view that the index seems to be changing its structural trend, I think we have to keep an open mind to Macquarie that it actually may be starting to look okay value down here. Again, the prospect of them delivering much above last year's earnings run rate of around $2 billion, I don't see as necessarily a strong probability. Therefore, we're likely to see the stock mostly trade sideways, but maybe gradually sort of moving up towards testing sort of that $75 level in the weeks and months ahead. NAB, I think we're looking at a technical bounce across the banking sector in the early stages of that playing out. Newcrest starts to look a little bit expensive for me, and I think gold's set for a pullback as equities sort of the risk on trade starts to come back into play again. Origin, as with Santos, Woodside Petroleum, there's a long way to go for these names to really start to provide clarity around earnings recoveries. But we are seeing better spot prices in both oil and natural gas markets, which is and then obviously we've got sort of the fact that Origin and Santos are actually beginning to ship cargo out of the Curtis Island projects there. So I think it's a slow recovery here in Origin. We've allowed sort of growth up to around $6.50 into sort of October, and I think that really captures the upside over the coming months. Orica, we've seen continued deterioration here in Orica's earnings, and we've seen them reduce their dividend payout ratio. And I think that continues to weigh on the price, so too early there for Orica. Oil Search, trending higher, fair value up at around $7.50. I think we could see that in the weeks and months ahead. Qantas not doing anything here at the moment. QBE, really a play on increasing US yields, and we're not seeing that. I think QBE, a combination of their share buyback that they're doing, maybe about 6%, 8% underlying earnings growth. It's worth keeping on the radar, but the technical structure is still negative there in QBE. Ramsay Healthcare, I think this name looks okay, albeit it's clearly expensive at 30 times earnings, but it's an area of the market that is trending higher and that bullish structure that we look for with the higher highs and higher lows. Rio, as with the banks and resources that I've spoken about, I see these in the early stages of a technical bounce. I think Rio could trade back up towards that $50 level fairly quickly. S32 not doing anything there at present. SCG, so this is the old Westfield Australian and New Zealand assets. We're seeing this trade up to an extraordinary multiple, up at around 22 times earnings. The company's only delivering about 3% underlying earnings growth. The stock's now compressing down to just scraping on a 4% dividend yield. But obviously, as interest rates come down, we're just seeing a continue inflow of money into these property trusts. And I just sort of question as to how much yield compression we can really see before we either just get into a period of consolidation or that they just get overvalued and there is some sort of pullback in the price. I think, again, to keep that in context, unless we really saw a spike in global yields and and effectively a collapse in bond prices, I don't see that the property names are at a huge risk. But at some point they can't just keep trending higher and compressing yields. At 3%, you're not getting rewarded a whole lot for for risk in pursuing sort of some of those names, and by reference there when I spoke about sort of Goodman and GPT and Centre Group, that in Westfield we're starting to see those yields really compress. Seek, I think this name's worth keeping on the radar. I think at around $15 it's good value. I think it can trade back up to around $16.50, $17. We'll be watching the upcoming earnings result and really looking for confirmation out of the company that they're meeting their targets, and looking for something in the order of 10 to 15% earnings growth there in Seek. Stockland's looking expensive up here for me. 18 times earnings, 5% dividend yield. I would prefer to sort of stand on the sideline a little bit there with Stockland's. Sonic Healthcare, I like this name. I think this is breaking out higher, trading at around 20 times earnings on about a 3.8% dividend yield. Owning it here and selling covered calls at around the 22.50 level generates about 10% cash flow, and I think it's relatively defensive, and I think that's probably a safe name to add into portfolios. Santos, as with Origin, they appear to be grinding higher off the back of an improving spot prices for energy, and I think in the case of Santos, it looks like it could probably trade up to around $5.50 throughout this current rally that appears to be underway. Suncorp, this could be a name that surprises in the upcoming earnings result. The stock trades about 13.5 times earnings on a 6% dividend yield. They should deliver around about 85 cents of earnings per share, and they'll pay out about 74 cents of that in dividends for the 2016 year. But this will be a name that we'll watch closely to see where the growth in the insurance business is tracking relative to that of the banking sector. So in next month's recording, we'll come back and take a closer look at what's going on inside the Suncorp business there. Sydney Airports, I think this name's defensive, but again getting expensive, trading down to a low 4% dividend yield. So to the extent that we own it, we're being aggressive with selling covered calls. The same with Transurban. And I think when you look across these property trust names and Transurban, Sydney Airport, so some of the defensive yield names, they're getting expensive. The yields have compressed. And I think we're probably, looking at an environment that they mostly track sideways. Can they really sort of go on that next leg of the rally and compress yields, down to sort of 3%? But again, I think that's getting to a point where you're just not getting adequately rewarded from a risk perspective in the market. And I think we're starting to sort of push up against the ceiling of the yield compression in some of these names. Telstra, I think this is one of the real bright spots of the market. I think given that the company's returning $1.5 billion to shareholders over the next 6 months, we'll look for clarity on that in the upcoming earnings result. I think the stock could trade up to around $6, but a combination of the dividend, the franking credits, the cash return to shareholders, I think Telstra looks interesting again. Westpac, in line with the broad view on the banks and resources, I think we're probably early stage of technical bounce. Wesfarmers, I like this name. Not much in the way of earnings growth. We've seen it ratchet back from around 8% earnings growth down to 5, down to around 3, and I think that's probably where it sits over the next 6 to 12 months, around 3% forward earnings growth. If we factor that in, the stock could trade up to around $43 on some yield compression. It trades on about a 5% yield at the moment. So in a bullish market, we could see it compress down to maybe around 4.5%, 4%. So I think it's a buy on the dip here and looking to sell covered calls up at around $43 to enhance that dividend return. And obviously allow for some capital growth and to create some sell side discipline there where we're taking profit where we think the stock starts to look a little bit expensive. In the case of Westfield, the stock trades about 23 times earnings on a 3.5% dividend yield. It'll be interesting to see the upcoming earnings result. They'll pay out about 38 cents of dividends per share. I think on a earnings basis, the company deliver maybe somewhere around 5 to 6% earnings growth. We own it at these levels and we're selling the tight covered calls to enhance the return. We prefer to play this on the basis that it mostly moves sideways and doesn't trade much above sort of that $10.70 to $11 range. Woolworths, so this will be interesting to see their upcoming earnings result, just to see whether there's any positivity out around the sale of the hardware assets of the company, and also just to see whether there's a turnaround beginning to take place through them passing on the discounts that the company, or passing on the savings that the company's creating into discounted product on the shelf, and trying to win market share back from Coles. Woodside Petroleum, been in lower lows, lower highs. The market's really looking for something positive out of Woodside over the next 6 months on the acquisition side of it. If that happens, we could see a bit of a re-rate here in Woodside. Otherwise, it's really just going to trade as a proxy to the performance of oil prices from these levels. So we could see a rally back up to sort of that $30 level, given some of the short-term momentum there. And then to conclude with the top 50 index, which is the XFL. So our base view is that for the last 18 months, the market's been in a negative structure, and the focus of money flows really been into defensive yield. We think some of those defensive yield names are starting to look a little expensive. We still prefer to be weighted towards them in portfolios, but using an aggressive derivative overlay to enhance the returns. And we're now mindful that it appears that we could be in the early stages of a bit of a rotation where money comes back into banks and resources. Thank you for listening in, and I look forward to speaking again next month. If you'd like to know more about the Investor Signal service, please contact me using the details on screen.